In 2017, there was an economic vision presented to the American people. This vision centered on the promise of increased job opportunities. A key component was the anticipation of higher wages for workers. The economic plan also aimed to make life more affordable for Americans. These promises formed the core of the economic agenda at the time. The focus was on improving the financial well-being of American citizens. In 2019, a notable economic trend was the increase in real wages. Real wages grew at a pace that outstripped the rate of inflation. This wage growth led to an enhanced purchasing power for a significant portion of the workforce. The increase in purchasing power reflects a positive shift in economic well-being for many workers. The year 2020 marked a significant disruption to global economic stability. This disruption created substantial shocks throughout various sectors. These shocks negatively impacted the established economic rhythm. One notable consequence was a marked decrease in affordability for many. The events of 2020 highlighted vulnerabilities in the existing economic structures. In 2025, a widespread concern among Americans is the rising cost of living. Multiple generations are affected by the increasing prices of goods and services. This economic anxiety prompts questions about the underlying causes of inflation. People are seeking explanations for why their purchasing power is diminishing. The rising cost of everyday items is impacting household budgets across the nation. This situation creates a sense of economic uncertainty for many American families. Grocery prices are subject to inflationary pressures over time. Price comparisons between different years can highlight the effects of inflation. The cost of the same goods increases due to economic factors. Visual aids effectively demonstrate the rising cost of living. Visual data indicates a notable shift in housing costs between 2017 and 2025. Housing price charts serve as a tool to illustrate these changes over time. The primary trend observed is an increase in the cost of housing during this period. These charts provide a clear representation of the financial implications for buyers and renters. Analyzing these trends is crucial for understanding market dynamics. Such analysis can inform decisions related to investment and affordability. Workers are facing increased financial strain. Families are struggling to maintain their living standards. Small businesses are encountering difficulties in sustaining operations. These groups are all experiencing challenges related to affordability. The rising cost of living is impacting various sectors of society. Affordability has become a central concern for many Americans. Rising costs of living are impacting various aspects of daily life. Housing, healthcare, and education are key areas where affordability is challenged. This issue is increasingly shaping economic and political discussions. The debate features multiple hosts. Each host represents a different generation. The central topic of discussion is affordability. The host will analyze affordability through their generational lenses. Gen Z faces unique economic challenges compared to previous generations. A significant portion of Gen Z reports a lack of perceived affordability gains. High rental costs are a primary factor contributing to this sentiment. Rent consumes a substantial portion of Gen Z's income. This limits their ability to save or invest in other areas. The high cost of rent impacts Gen Z's overall financial well-being and future prospects. Millennials report an increase in wages over time. However, the cost of housing has risen at a faster rate than wages. Similarly, childcare expenses have increased more rapidly than income. This disparity creates financial challenges for the millennial generation. Generation X experienced real wage growth prior to the COVID-19 pandemic. This period of wage gains contributed to their financial stability. The COVID-19 pandemic significantly impacted Gen X's financial security. Many Gen X individuals saw their financial stability diminish due to the pandemic. The pandemic effectively reversed some of the financial progress made by Gen X. Boomers perceived the Trump years as a period of stability. This perception created an expectation of continued stability. The 2025 crisis, therefore, felt like a betrayal of that expectation. This sense of betrayal stems from a disruption of their perceived stable environment. In round one, real wages demonstrated a growth rate exceeding inflation. This indicates that purchasing power for workers increased during this period. Concurrently, the unemployment rate reached historically low levels. The combination of rising real wages and low unemployment suggests a strong labor market. Wage gains were not uniformly distributed across the population. The cost of essential services increased at a higher rate than wages. Housing expenses significantly outpaced wage growth. Healthcare costs also rose faster than average earnings. This disparity was particularly pronounced in major metropolitan areas. The COVID-19 pandemic created a sudden and severe economic crisis. Emergency relief measures were implemented to mitigate the economic impact on households. These relief efforts included direct payments and expanded unemployment benefits. The primary goal was to provide immediate financial assistance to individuals and families. This intervention temporarily increased household income during the crisis. The income boost aimed to stabilize consumer spending and prevent a deeper recession. The COVID-19 pandemic led to significant job losses across various sectors. Economic instability increased due to business closures and reduced consumer spending. Long-term economic challenges, or scarring, affected numerous individuals and families. These factors collectively diminished the financial stability and affordability for a large segment of the population. The 2021 to 2025 inflation wave is a subject of debate regarding its causes. One perspective suggests it was a global phenomenon. This view posits that the inflation was not exclusively caused by Trump-era policies. Instead, broader global factors may have contributed significantly. This perspective challenges the notion of sole responsibility. Some analysts attribute the 2021 to 2025 inflation wave to pre-existing structural weaknesses. These vulnerabilities are said to have accumulated between 2017 and 2020. The argument is that these weaknesses amplified the impact of inflationary pressures. This perspective contrasts with explanations focusing solely on immediate post-2020 events. Understanding these structural vulnerabilities is crucial for effective long-term economic strategies. The year 2025 is marked by a significant affordability crisis. Grocery prices have risen sharply, impacting household budgets. Rental costs are substantially higher, straining renters' finances. Insurance premiums have increased, adding to financial burdens. Energy costs are up, affecting expenses for heating, cooling, and electricity. These combined increases create a widespread affordability challenge for many. Real wages are not increasing at the same rate as the cost of essential goods and services. This disparity creates an affordability crisis for many individuals and families. The crisis is characterized by a struggle to maintain a basic standard of living. Rising costs of living can outpace income, leading to financial strain. The central debate question focuses on the origins of the 2025 crisis. One perspective argues the crisis's roots were established before 2020. This suggests pre-existing conditions or policies contributed to the crisis. The opposing view posits that the crisis emerged primarily after 2020. This implies that more recent events or decisions were the primary drivers. The question arises whether economic success should be judged solely on aggregate metrics. A key consideration is whether the average person can afford a stable life. This includes access to basic necessities such as housing, food, and healthcare. An economy might show overall growth but fail to provide for its citizens' basic needs. Therefore, economic success should also be evaluated by the well-being and stability of the average individual. The debate transitions from statistical analysis to philosophical considerations. This shift involves exploring the underlying values and principles that define economic success. Philosophical arguments delve into the ethical dimensions of economic policies. The discussion broadens to include societal well-being and equitable distribution of resources. The focus moves beyond mere numerical indicators to encompass broader humanistic values. This philosophical approach seeks a more comprehensive understanding of economic progress. Affordability extends beyond simple gross domestic product (GDP) calculations. It encompasses the fundamental ability of a family to secure essential resources. This includes access to clean air, a basic necessity for survival and well-being. Therefore, a true measure of affordability considers environmental factors. The capacity to afford to breathe is a critical component of overall economic welfare. Affordability is a key factor determining a young person's ability to achieve residential independence. High costs of living, including rent and utilities, can delay or prevent young adults from moving out. When young people remain at home longer, parents may have reduced capacity to save for retirement. Therefore, affordability directly links the financial well-being of both younger and older generations. Affordability is a key determinant of financial security in retirement. Retirees need sufficient income to cover essential living expenses. Unaffordable living costs can lead to financial strain and insecurity. Adequate retirement planning should prioritize affordability considerations. Affordable housing, healthcare, and transportation are crucial for retirees. Financial insecurity can significantly impact a retiree's quality of life. The Trump economy led to increased buying power for certain segments of the American population. This boost in buying power was not uniformly distributed across all Americans. Some Americans experienced economic gains during this period. Other Americans were left behind, not benefiting from the economic policies. The economic outcomes under the Trump administration were therefore uneven, creating disparities among different groups. The affordability crisis of 2025 highlights a critical issue in America. It suggests that economic growth alone is insufficient to address societal needs. Fairness in resource distribution is essential for overall well-being. Focusing solely on growth can exacerbate existing inequalities. A balanced approach is needed, prioritizing both economic advancement and equitable access to resources. Boomers experienced substantial financial gains due to asset appreciation. Asset appreciation refers to the increase in the value of investments over time. This increase in asset value significantly contributed to their financial stability. Boomers benefited from favorable economic conditions that supported asset growth. Generation X faces unique financial challenges. They are significantly impacted by childcare costs. Healthcare expenses also place a substantial burden on Gen X. Additionally, they often bear responsibility for the needs of aging parents. These combined pressures create a financial squeeze for this generation. Millennials face significant challenges due to elevated housing costs. High housing expenses reduce millennials' financial flexibility. This financial strain impacts their ability to save and invest. Limited financial flexibility affects their long-term financial goals. These goals include homeownership and retirement savings. Therefore, housing costs are a key economic factor for millennials. Gen Z faces significant financial barriers early in their careers. Many opportunities are unaffordable for Gen Z due to pricing. This economic disadvantage impacts their career trajectory. High costs limit access to essential resources and experiences. These financial constraints create an uneven playing field for Gen Z. Housing costs continue to be a significant financial challenge for many Americans. These costs represent a primary obstacle to overall affordability. Structural factors within the housing market contribute to these high costs. Addressing these structural issues is crucial for improving housing affordability. Healthcare costs represent a substantial financial strain on household budgets. These costs encompass a wide range of medical services and products. The financial burden can limit access to necessary care. High healthcare costs can lead to financial instability for families. The increasing costs affect both insured and uninsured individuals. Addressing these costs is crucial for economic well-being. Education expenses place a significant financial burden on families. These costs can include tuition fees, books, and supplies. Additional expenses may arise from transportation and accommodation. The financial strain can impact families' overall economic stability. Childcare expenses represent a substantial financial burden for working parents. These costs significantly impede the affordability of living for families. High childcare costs can limit parents' ability to participate in the workforce. Many families struggle to balance work and childcare responsibilities due to financial constraints. This financial strain can affect career advancement and overall family well-being. Addressing childcare affordability is crucial for supporting working families and promoting economic stability. The 2025 crisis served as a critical wake-up call regarding economic stability. It revealed the underlying fragility of previously achieved affordability gains. This fragility indicated vulnerabilities within the economic system. The crisis underscored the need for more resilient economic strategies. It highlighted the importance of sustainable affordability measures. The events of 2025 prompted a re-evaluation of economic policies. Economic crises highlight vulnerabilities in household finances. These events reveal how unprepared many households are for financial shocks. A crisis acts as a wake-up call, exposing existing financial weaknesses. Households may face challenges in managing unexpected economic downturn. This exposure underscores the need for improved financial resilience and planning. The strength of an economy is directly linked to the financial well-being of its population. A robust economy requires a significant portion of its people to have sufficient purchasing power. This affordability ensures demand for goods and services, driving economic activity. Therefore, widespread economic participation is crucial for a healthy and sustainable economy. The question is posed: what kind of economy should we leave for the next generation? This prompts consideration of our economic legacy and its impact on future lives. It necessitates a focus on sustainable practices and long-term economic health. Ultimately, it calls for responsible stewardship of resources and opportunities for those who follow. The graph visualizes wage growth trends over a specific period. The data spans from 2017 to 2020, illustrating changes in wages. The visualization focuses on the rate of increase in wages. The graph provides a clear picture of wage dynamics. Wage growth trends are presented in a graphical format. The visualization presents the inflation rate trend over a specific period. The chart spans from 2017 to 2025, illustrating inflation dynamics across these years. The primary focus is on highlighting periods characterized by high inflation. These periods are visually distinguished to emphasize their significance. Analysis of the chart allows for identifying key inflationary episodes and their magnitudes. The Housing Affordability Index is a metric used to assess the ease with which a typical household can afford housing. It quantifies housing affordability by measuring the proportion of income allocated to housing costs. The index typically considers expenses such as mortgage payments, property taxes, and insurance. A lower index value indicates that a larger percentage of income is needed for housing. Conversely, a higher index value suggests greater housing affordability relative to income. This index provides insights into the financial burden of housing on households within a specific region or market. Healthcare service costs are steadily increasing. Insurance premiums are also experiencing a parallel rise. This trend indicates growing financial burdens on individuals. The graphic representation highlights the escalating expenses in healthcare. The cost of higher education, including tuition and fees, is generally increasing. This trend impacts students and families planning for educational expenses. Rising costs can affect accessibility and affordability of higher education. Understanding these trends is crucial for financial planning and policy decision. Childcare costs can vary significantly depending on geographic location. Regional economic factors influence the pricing of childcare services. Areas with higher costs of living generally have more expensive childcare. Urban centers often present higher childcare expenses compared to rural areas. The graphic representation highlights these regional disparities in childcare costs. Families should consider these trends when planning for childcare expenses. The analysis focuses on comparing debt levels among different generations. Student loans represent a significant portion of debt for younger generations. Mortgages are a primary debt component for older generations. The chart visually represents the distribution of debt types across generations. This comparison highlights the shifting financial burdens faced by each generation. Savings rates vary across different generations. These rates are often visualized in charts for comparison. The comparison of savings rates can indicate levels of financial security. Analyzing these rates provides insights into generational wealth accumulation. Poverty rates are often analyzed across different age groups to identify vulnerable population. These analyses typically involve visualizing poverty rates using charts and graphs. The charts highlight the prevalence of poverty among specific age demographics. Certain age groups may experience disproportionately higher rates of poverty compared to others. Identifying these vulnerable age groups is crucial for targeted intervention and policy development. Unemployment rates are visualized using a graph spanning from 2017 to 2025. The graph illustrates fluctuations in unemployment levels over this period. Specific intervals on the graph indicate periods marked by job losses. These periods reflect economic conditions that led to workforce reductions. Analyzing the graph helps identify trends and potential causes of unemployment. The data provides insights into the labor market dynamics during the observed years. The Consumer Confidence Index, CCI, is designed to measure the degree of optimism consumers have regarding the overall state of the economy. It reflects how confident people feel about their income stability. The CCI also captures consumers' perceptions of the current economic climate. It gauges expectations for short-term economic growth. This index is used to forecast consumer spending and overall economic activity. GDP growth rate is a key indicator of economic expansion. It measures the percentage change in GDP from one period to another. A positive growth rate indicates the economy is growing. The graph illustrates GDP growth from 2017 to 2025. Federal Reserve interest rates influence the cost of borrowing money. Changes in these rates affect various aspects of the economy. These include consumer spending and business investments. Lower rates typically encourage borrowing and spending. Higher rates tend to curb inflation by increasing borrowing costs. Government spending includes allocations for various social programs. These programs aim to provide assistance and support to specific populations. Social Security is a major component, offering income support to retirees and the disabled. Medicare provides health insurance coverage for seniors and certain disabled individuals. Government expenditure on these programs reflects a commitment to social welfare. The period from 2017 to 2025 saw significant changes in tax policies. These changes have varying impacts across different income groups. Understanding these impacts requires analyzing specific tax law modifications. Tax policy adjustments can affect income, distribution, and economic activity. Analyzing these changes is crucial for assessing their overall economic effects. Trade policies significantly influence the prices of goods in both domestic and international markets. These policies can either increase or decrease the cost of imported and exported products. Trade policies also affect the availability of goods to consumers and industries. Restrictions or incentives can limit or expand the variety and quantity of products available. Analyzing trade policies provides insights into their direct and indirect impacts on market dynamics. Supply chain disruptions can lead to increased production costs for businesses. These increased costs are often passed on to consumers in the form of higher prices. Reduced supply due to disruptions, coupled with steady or increased demand, creates inflationary pressure. Therefore, supply chain disruptions are a significant contributing factor to overall inflation rates. Energy price volatility refers to the degree of fluctuation in energy prices over a specific period. High volatility means prices can change dramatically and unpredictably. These fluctuations directly impact household budgets. Increased energy costs can strain household finances. Volatile energy prices make financial planning difficult for households. Understanding energy price volatility is crucial for managing household expenses effectively. Rent control policies are regulations that limit the amount landlords can charge for rent. These policies aim to make housing more affordable, especially in high-demand areas. Rent control can take various forms, including strict caps on rent increases or vacancy control. The effectiveness of rent control is debated, with some studies showing negative impacts on housing supply. Different cities have implemented rent control with varying degrees of success and challenges. Minimum wage laws are regulations that establish the lowest hourly wage employers can legally pay to employees. These laws aim to protect low-income workers by ensuring a basic standard of living. The impact of minimum wage laws on employment levels is a subject of ongoing debate among economists. Proponents argue that it reduces poverty and stimulates economic activity by increasing consumer spending. Opponents contend that it leads to job losses, particularly for unskilled workers, as businesses reduce staff to offset higher labor costs. Studies on the effects of minimum wage laws have yielded mixed results, with some showing minimal impact on employment and others indicating negative effects. Affordable housing initiatives aim to provide housing options for low to moderate income households. These initiatives often involve government subsidies, tax incentives, and public-private partnerships. Success rates vary depending on factors like funding, availability, community support, and effective management. Key metrics for evaluating success include the number of units created, affordability levels, and resident satisfaction. Challenges include rising land costs, regulatory hurdles, and ensuring long-term affordability. Job training programs aim to enhance individual skills and qualifications. These programs are designed to improve employment rates among participants. Analysis focuses on the effectiveness of various training approaches. Impact is measured by tracking participants' employment status post-training. Successful programs demonstrate a positive correlation with increased employment. Financial literacy education programs aim to improve individuals' understanding of financial concepts. These programs cover topics such as budgeting, saving, investing, and debt management. Effective financial literacy education can lead to better financial decision-making. Improved financial literacy can also contribute to greater financial stability and well-being. Government assistance programs are designed to support individuals and families in need. SNAP, or the Supplemental Nutrition Assistance Program, provides food assistance to low-income individuals and families. TAN, or Temporary Assistance for Needy Families, offers financial aid and support services to families with children. These programs aim to alleviate poverty and promote self-sufficiency among vulnerable populations. Automation is increasingly transforming job availability across various sectors. The integration of automated systems can lead to displacement of workers in routine-based roles. Automation may also influence wage levels, potentially creating disparities. Analysis is needed to understand the full scope of automation's effects on employment and compensation. Remote work trends are reshaping traditional employment landscapes. Increased remote work opportunities can impact housing affordability in certain areas. Remote work may lead to migration from expensive urban centers to more affordable locations. This shift can redistribute economic activity and influence local economies. Affordability differs significantly between urban and rural settings. Urban areas often have higher housing costs and living expenses. Rural areas may have lower wages and limited job opportunities. Transportation costs can be a burden in both urban and rural areas, albeit for different reasons. Understanding these differences is crucial for addressing affordability challenges effectively. Cost of living adjustments, COLAs, are designed to maintain purchasing power. COLAs adjust wages and benefits in response to changes in the cost of goods and services. These adjustments are typically linked to the Consumer Price Index, CPI. The CPI measures the average change over time in the prices paid by urban consumers. COLAs help employees and beneficiaries cope with inflation. By increasing income, COLAs aim to offset the rising cost of living. Healthcare reform initiatives aim to modify healthcare systems. A primary goal of reform is to improve affordability of healthcare services. Analysis focuses on the impact of specific reforms on healthcare costs. This includes examining changes in insurance premiums and out-of-pocket expenses. Reform effects are evaluated based on access to affordable care. The analysis determines if reforms successfully lowered financial barriers to healthcare. Student loan forgiveness programs are initiatives designed to cancel or discharge a portion or the entirety of a borrower's student loan debt. These programs aim to alleviate the financial burden on individuals struggling to repay their student loans. Eligibility criteria vary widely depending on the specific program, often based on profession, income, or type of loan. Common examples include programs for public service employees, teachers, and those working in healthcare. Forgiveness can be a significant benefit, freeing up borrowers' income for other expenses and investments. However, some forgiveness programs may have tax implications, potentially requiring borrowers to pay taxes on the forgiven amount. Many individuals face significant challenges in accumulating sufficient savings for retirement. One primary challenge is the lack of consistent and early savings habits. Insufficient financial literacy can lead to poor investment decisions and inadequate planning. Unexpected life events, such as job loss or medical expenses, can deplete savings. Inflation erodes the purchasing power of savings over time, requiring larger nest eggs. Longer life expectancies necessitate greater savings to cover extended retirement periods. Social Security reform aims to ensure the long-term sustainability of the program. Reform proposals address potential funding shortfalls due to demographic shifts. Common proposals include adjusting the retirement age and benefit levels. Another approach involves modifying the payroll tax rate or the income base subject to it. These reforms seek to balance benefits for recipients with the financial health of the system. Economic inequality refers to the disparity in income and wealth distribution among individuals or groups within a society. Trends in economic inequality are often visualized using charts that depict the gap between the rich and the poor. These charts typically illustrate how the share of income or wealth held by the top earners has increased over time. Conversely, they show that the share held by the bottom earners has either stagnated or decreased. The widening gap indicates a growing concentration of economic resources among a smaller segment of the population. Policy recommendations aim to address the affordability crisis. These recommendations also focus on promoting economic fairness. The goal is to create a more equitable economic environment for all. Effective policies are crucial for improving affordability and fairness.